Hi, I'm David Brickell, Director of Institutional Sales at Paradigm and Paradigm's resident macro man. I'm not joined today by my regular co-hosts of The Big Picture. Given everything that's gone on over the past week, we decided to postpone. But I thought it might be worthwhile jumping on to quickly share some thoughts about exactly what's been going on, what I think it means for markets, and what I think it means from a big picture framework for crypto. The first thing I want to say is events over the past week ultimately are my long-term bullish thesis for crypto playing out real time. And that is a fiat system swimming in debt, simply unable to sustain higher rates for any period of time. I think in a post-2008 world, markets are addicted to low rates and liquidity. And as soon as you start to remove that, quite quickly things break. And I think it's fair to say over the past week, we've started to see things break. Now, somewhat perversely, I was hoping that something would be the economy and particularly inflation, but it looks to be the US banking system that's coming under pressure. And effectively what we've seen is a classic bank run with deposits fleeing banks in search of higher yields that they can earn in money markets. Now, the reason banks have been unable to simply hike deposit rates to keep those deposits is the fact that we have this inverted yield curve. So to do so effectively would be at the cost of profitability. So banks have been able to hike deposit rates. Money's leaving those banks in search of higher yields elsewhere, and it's starting to cause a few problems. Now, to meet those liquidity needs, eventually banks need to start selling their assets. Now, the problem, certainly in the case of SVB, was they saw massive deposit inflows, as many banks did during COVID, as fiscal policy effectively put cash in people's pockets and found its way into the banking system. Now, they took a lot of those deposits and invested them sort of longer term, in longer duration assets and predominantly treasuries. Now, those treasuries are clearly underwater given the sharp hike cycle we've seen out of the Fed. Now, that's typically not a problem given that banks don't have to mark to market those, so long as they're deemed as held to maturity. But obviously, if they're needing to sell them to provide liquidity, then quite quickly they're realizing a loss, and a liquidity issue quite quickly becomes a solvency issue. And we kind of saw similar things play out in 2008. I had a front row seat to that at Lehman's, and things don't really change. And in fact, I'd say the system now is more bloated, central bank balance sheets are more bloated, so potentially the problems are even larger. Now, the reaction of the US regulators and the Fed, the sort of big thing that they've done has been to announce this bank term funding program, BTFP, as someone I saw say, buy the fucking pivot. Now, what that does, this allows banks to raise liquidity by essentially using their treasuries and mortgage-backed securities and other eligible collateral as collateral to then receive liquidity, and they're going to give them that liquidity at par. So rather than having to realise the loss, the Fed would essentially give them that cash at par and lend it for a year. So that's going to help for short term at least address some liquidity issues and maybe stop a little bit of this contagion, and certainly from a solvency point of view. However, what it doesn't do is it doesn't address the issue that effectively front-end rates are simply too high. So banks are still going to struggle with deposit outflows and are going to increasingly need to start tapping these facilities to raise liquidity. Now, this runs kind of somewhat counter to what the Fed are trying to do in terms of tightening liquidity and tightening rates to fight inflation. But I always say that banks aren't simply about fighting inflation. They're fundamental to market function and liquidity. And once again, we're starting to see the Fed have to step up and provide that liquidity. Now, in the past week, due to what's been going on, we've seen the Fed balance sheet explode by 300 billion. So just to give a kind of sense of how much liquidity now they're having to inject back into the markets, they're completely unwinding the quantitative tightening that they were trying to do, and it offsets pretty much all what they've done since the fall of last year. Now, where do we go from here? Ultimately, look, this doesn't stop until the Fed certainly pause and cut rates. The idea that I'm seeing some people out there say that the Fed can, on the one hand, provide liquidity and then also hike rates to address inflation, it just can't work out that way, because central bank balance sheet, the Fed balance sheet, is going to explode higher. So ultimately, the Fed are going to have to pause. And they've got a pretty much impossible choice to make between inflation or the financial system. But as we know, historically, they'll always choose the financial system as the lesser evil. And I think we're starting to see that play out. So I think from here, I expect we'll see more banks in trouble. I don't think this ends here. I think we're going to see more and more banks starting to tap both the BTFP, and actually most of the borrowing actually came from the Fed discount window, which is another facility that the Fed have to provide liquidity. So banks are clearly struggling for liquidity. The Fed are having to provide it. So the Fed balance sheet is once again in expansion mode. Now, I've talked about before how markets, and particularly crypto, are a function of rates and liquidity predominantly. So what we've seen obviously a sharp reversal in rates coming lower, which we were looking for and actually spoke about on the last the big picture. And now we're starting to see this explosion of liquidity being injected back into markets. Now, I mean, there's the potential for the amount of treasuries and MBS that banks hold, US banks hold, is in excess of 4 trillion. JP Morgan were out earlier in the week estimating that this could inject up to, say, 2 trillion of liquidity into markets. So we're going to see this huge liquidity injection into markets. I don't think the Fed can do that and keep hiking rates at the same time. As I say, it's going to continue to precipitate this need for banks to kind of go and take more liquidity from the Fed, as deposits will continue to flood out in search of higher rates. So we're in a really tricky situation for central banks, and ultimately they will look to preserve the banking system, and they will need to pause. So my expectation into next week is that we'll see a Fed pause. And eventually we'll see the cuts come further down the line. Now, I think they can justify that, on financial stability concerns, but also the other thing I think we're going to see now is the sharp slowing of the economy, particularly as banks effectively are going to stop lending into the economy. So we're going to see a bit of a credit crunch, I guess. We'll quickly see growth start to come down and inflation will follow, and that will be reason enough for the Fed to take a pause and eventually start to cut rates. So ultimately what I think this means for crypto, I came into the year bullish in a way, thinking that we'd see the data soften, Fed will pause, maybe cut towards the end of the year, and we were looking at a very different macro regime to the one that we had in 2022. Obviously, things have changed quite dramatically over the past week as the financial system looks to be in trouble. So I kind of think that bullish view that I had on crypto, on an easier Fed cycle into 2023 and also easing liquidity, I think we're now seeing that on steroids. So yeah, it makes me super bullish crypto over the rest of this year. Directionally at least, I think we've got a lot further to go. We all know what the convexity looks like in crypto. Our flows certainly this past week, we're seeing record volumes almost daily at Paradigm as institutions scramble to pull on the top side. So I don't see that ending anytime soon. I mean, people to ask me about targets for crypto. I came into this year saying Bitcoin could go to 40k just on a pause and this sort of peak inflation narrative. If we now got a Fed that's going to have to pause and even cut rates despite inflation, although I do think inflation will come quite quickly lower, then we need to ratchet up those targets sort of pretty quickly. And who knows, maybe those 100k targets that people spoke about for Bitcoin start to play out this year. I think the other thing to be cautious of here is particularly the move we've seen in rates is a huge VAR shock to the system. And when you have a VAR shock, the first thing that everyone has to do, that risk managers have to do, is gross down risk. So I think what we're seeing for now is some grossing down of risk. I think I've spoken before about the lack of positioning in markets, and I think that's why we've not had a bigger sell-off in risk, and actually why we're trading quite well. You can certainly see where positioning was short, and which is why I think the Nasdaq has actually sort of outperformed, as well as obviously benefiting from a lower rate, higher liquidity environment. So I think first point of call is we're going to see continued sort of degrossing in risk, which might weigh on equities a little bit, and to a lesser extent on crypto. But once that deleverage played out, I think we're setting up for one almighty rally for crypto, as we completely reverse the rate hike cycle that we saw over the past 12 months, and as liquidity starts to get injected back into these markets, and the Fed balance sheet starts to explode once again. Bitcoin and crypto is a liquidity junkie, and they're starting to get their fix once more.